welcome to everybody who's joining our webinar. We have got quite a few registrants today from lots of different directions. People sort of, some of our own existing customers at Coolcare, but also from various different sort of sources. So we're going to just hold off for a couple of minutes whilst the sort of the registration kind of adds up, if you like, and people are joining as it sort of goes along. So we'll just hold off for a minute. But whilst you're kind of looking at me, I'm Ian Corrigan. I'm the commercial director of Coolcare, and with us today is Jonathan Russell from Virgin Money, and he's going to be talking all about what lenders really want, unlocking finance for your care home. So we'll just wait for a minute or so, and then we'll kind of crack on. In fact, actually, yes, that was a couple of minutes. So let's go. So today, what we're going to be talking about, quick introductions. Then we're going to go through the meat of what we've got to talk about is what actually makes care home investable or care home business investable. So a little bit of insight from L&T Care Developments, who have built a third of all the new care homes in the UK last year. And so we're insight from what they get up to, and then a summary, and then closing remarks, and then some Q&A at the end. Now, you should be able to see on your on your kind of Zoom sort of portal that you can, there is a chat space, so you can pop some chat questions in there if you've got immediate questions, or if you prefer, you wait to the end of the presentation and we have that Q&A session. I'd be inclined to say if it's a kind of a burning question about, what is it you mean when you just said X, then by all means ask. But if it's something more broad and general, it probably makes more sense to leave to the end and sort of let Jonathan field those questions. So, Jonathan, thanks for joining us.
Good morning.
Well, I mean, we all know Virgin Money. I mean, it's not as if it's it's a really, really strong brand, but it's interesting that you have an actual dedicated health and social care team. So tell us a little bit about kind of what you guys get up to in that team, and a little bit about yourself. I mean, you've been doing this for over 30 years, so tell us about that.
Yes, thanks, Ian, and morning to everybody. Just quickly a little bit on myself. I've worked in banking for 35 years, Virgin Money, previously Yorkshire Bank. Obviously, the healthcare team started at Yorkshire Bank, and we've moved on to Virgin Money 3 or 4 years ago. As well as working in the healthcare sector, I've had other roles. I've had roles in credit. I've done some turnaround supporting businesses that perhaps were having some challenges. So I've got some experience of a broad range of bank funding. So hopefully that can help, with our conversations today. The Virgin Money healthcare team, that was founded back in 2010, and it started with myself and a head of healthcare who's still with us, Derek Brennan, who may be well known to a lot of people. And we've expanded over the years. We're now a team of 28. We work nationally. We fund developments, acquisitions. We also do private equity. We've also got a dedicated real estate team within the healthcare team, which I believe is unique across bank funding. So we very much cover the wide spectrum of the sector. I think it's important to have a healthcare team because there are some nuances in healthcare funding that if you don't understand the sector, you could get wrong. You maybe don't understand. We understand the sector. We can support people looking for funding, operators. We can speak the same language, which I think just helps, when we're coming to that relationship piece that we look to do.
Yeah, so I presume that kind of makes like understanding the business and the motivations and the organization and the personalities that are kind of wanting to do the lending easier, because you kind of understand what it is. You've been there before, you've seen what good looks like, and you're able to better advise. And that's why a dedicated team, as opposed to kind of just a team that lends to retail, leisure, anything is different.
Absolutely. The terminology that's used in the healthcare sector, it is unique. And I think, as I said, there are nuances, and it's useful to be able to have proper in-depth conversations and understand what we're being presented with. I think you can only do that through a dedicated team such as ourselves.
Got you. And just to sort of clarify then, so the type of lending you're talking about is what? So it's kind of it's potentially buying into an existing operating care home
Yep.
business, but also what else? What other sort of things are you really talking about? And I suppose also to a certain degree, Jonathan, what are you not talking about?
Right. Yes, absolutely. I think to be clear on this webinar, I can't talk about where base rates may go. I'm not going to talk about interest rate margins on there. No, unfortunately not. I'm not going to talk interest rate
had a
margin
whole
might be offered.
a whole lot
Yeah,
of people just left.
absolutely. The numbers have gone down. No, unfortunately, I don't have a direct line to the Bank of England for what's going to happen to interest rates. So
Oh,
I won't be picking up on that, I'm afraid. I also won't be talking about sort of interest rate margins. Each application is unique. And each risk is different. So we're going to keep it sort of higher level than getting into the generic and of specific, terms and conditions that you may have for an application. You're right. Within my portfolio, within the Virgin Money Health and Social Care team, we fund acquisitions. We're not really looking at pure startups, but there are funders out there that will look at that. We support a number of regional operators. I've done a number of new developments. We'll support private equity to come in and acquire. And I say we will do real estate where the property's been retained and it's been leased out to an operator. So we do cover quite a wide spectrum of funding. We also do specialised lending as well. That's a key area where I think you do need to understand the sector to be able to support and fund.
so and then so not so much. I've got a patch of land. I'm going to build a £500,000 brand new care home from scratch that's never existed before. Ta-da! So that's not so much your thing, but on the I suppose that's on the top end of the spectrum. It's kind of like that's
well. No, I
that's
mean developments. I mean, sort of 500,000 now, but I mean a new development. I'm just looking at one now. It's probably £16 million. It's costing us, as probably you well know, Ian. And
yeah,
we will provide development funding on an SPV basis.
gotcha.
Which will be projection led, which is unusual. Normally, you look at historical trading performance, which we will touch on, I know, in the slides
Yeah,
to come. But no, absolutely, we will fund new developments to experienced operators,
gotcha.
and experienced developers.
And that could be anything down to kind of looking at refurbishing. I'm looking
Yes.
at kind of an extension, an extra
Yep.
10 beds on a
Absolutely.
40-bed care home. So.
We've done all that. I'm just doing a refurb down in London at the moment where they've closed an 80-bed home, residential care, and they're reopening it up as a specialist care,
Right.
another 80-bedder. But so they're not changing the building,
Yep.
but the fabric and inside, yes, it's
Gotcha.
been refurbed. So
Right.
we funded the purchase and we're refunding
So
the.
that got you. I think that's really helpful because it's kind of like the scope of the conversation is actually really quite broad. Then, really, it's not
Absolutely,
just
yeah.
sort of just we only do one thing. It's kind of we've got all sorts of different things. And I notice also, health and social care. It isn't just adult social care, which is obviously what Cool Care often talk about because we're a care home
Yeah.
software provider, but it's also other types of care as well. So suitable for organisations that are kind of hybrid, bit of a mix.
Yep.
Could be doing a bit of, could be watching this because they also have some other care services as
GPs,
well.
pharmacies, even vets fall under our health and social care remit.
Excellent. Brilliant. Thanks very much for that introduction. So I think many people on this call will probably know Cool Care because some of them are existing customers, but many don't. So just to be clear, we're a care home administration software company. And I was having a chat with somebody the other day. Said Ian, what are you up to with webinars? And I said, I'm doing one with Virgin Money. He's like, well, why are you in a software? You do software, right? It's like, yeah, we do. But our kind of raison d'etre is all about operating care homes easier, more efficient, and more profitably. And that leads you on to the kind of, well, what are you going to do with the profitable business if it's working well? Well, you might want to grow, you might want to expand. That's kind of where we're coming from. We've got, we're built with business efficiency in mind, running smoother, and we've got a very, 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 very high retention rate. So customers are clearly very happy with us, and we're all about kind of saving time and money, which is the stats at the bottom. What a lot of people don't always realize is that Cool Care is part of L&T Care Developments. That's a name that's not that well known, but it's known by many, but not known by kind of the layperson. And L&T Care Developments build and operate care homes. So they build 2 brand new 66-bed care homes a month and then operate themselves under various different names. So Ideal, Halcyon, Danforth are names that used to be part of L&T Care Developments. They were built, run, operated and have been sold on. Crystal Care, Oyster, and Adore are ones that are continuing to be operated by ourselves, and there are more in pipeline. They have approximately 150 66-bed care homes in pipeline. They're going to be building them for a while, and out of all the new homes that were built last year, L&T Care Developments built a third of them. So that makes you kind of realise that clearly, we as an organisation know something about operating efficiently, and you can't really open 2 brand new care homes a month if you haven't got your operations in a tight and efficient manner. So that's kind of where we're coming from with sort of explaining that there. But enough of us. So, Jonathan, tell us about market outlook. How do you see things?
I mean, it's a very positive sector. I mean, the demographics themselves, we're an aging population, and the demand for care and care beds in particular is only expected to increase. The challenge is that care beds are not keeping up with the demand. We had a conversation earlier. I think you said 7, I said 85 net increase in beds in 2024. So despite all the new homes that are being built, we're still not keeping up with demand. And I suppose that also then means there's still a requirement for the older homes. I think there is sometimes a perception that everything has to be new and shiny. That's not the case. It can't be the case, and there's still very much a market and a need for the existing, stock of care homes who are run very well. I have a number in my portfolio I look after. Probably late 90s, early 2000s, providing an exceptional level of care. It's the staff sometimes, not the home, that matters. So there is very much a need for those homes, and very much a funding market for people to buy and acquire the homes, to provide the care that people desperately need.
And it's interesting because it's sort of not a short-term thing either. So we talk an awful lot about a wave of aging population. That the baby boomers are reaching an age where care is relevant. And I think there's not anybody in the care sector that doesn't know that, but the demographics are continuing to be high. There's still demand even in the future. So add 10 years, add 15 years, it's still a sector that is so it's almost not going out of fashion.
The fundamental fact is we're not building enough. Now, for operators, that's good in a way because it keeps occupancy high. It means fees can be maintained and increased to cover the ever increasing costs. But fundamentally, we still do need more care beds.
And obviously, that last little point there, on average, 16 care homes closed per month. So, if anything, the balance is going down as fast as it's going up. Really, it goes back to your 7 versus 84.
Yeah, I mean, unfortunately, care homes are closing. They are experiencing increased costs, and it is probably the smaller homes, the older homes, the converted homes that have a higher repair and capex requirement to maintain the standards required for care that we are seeing leaving the market. Gotcha. Just at a faster rate at the moment than the ones that are being built. As you well know, Ian, it takes 2-3 years to build a new home.
Yeah.
And that's after planning as well. So there is a long lead times into these new ones.
Absolutely, yeah. Excellent. So as far as you're concerned, I mean, obviously you have an entire team for this sector. Things are looking very positive as a sector. There's a lot of opportunity in the sector.
There is, and we're seeing a lot of new funders come in, recognising that perhaps some of the other sectors aren't as positive. Retail, potentially, hospitality are challenging sectors. So we are seeing a lot of funders coming into the healthcare market, and so it's probably never been a better time for somebody wanting funding to look for it.
Good. Kind of pushing against the door that's happy to be open.
Mm-hmm. Yes.
So, first point that you have is all about management control. So, talk us through this.
Yeah, I mean, I think the first 2 slides probably link together, and looking at it under a lens of what do banks look for when we're funding. I mean, one of the key things is how well are the homes operated. CQC ratings gives us a window into how well the homes are being run. I think it's fair to say the CQC are having some challenges at the moment from webinars I've attended. However, they are the public view of how a care home is operated. It always used to be the case, requires improvement for a bank. It made it more difficult to fund. There are still some funders out there, I believe, that if it requires improvement, it's no. I think this is where being a dedicated team comes in, because it's understanding what's behind that requires improvement. I mean, it goes out saying good and outstanding, very positive tick. If you're looking for funding, if you're getting a good and outstanding, yeah, absolutely tick the box and probably move on. Requires improvement just needs a little bit more work. And I say links into the operation capability. One of the key issues we're seeing on CQC inspections and requires improvement tends to be management. So it's understanding the management. Are they experienced team? What are the issues behind that plan, behind the required improvement? Share information with the bank. I think the key point I would say is don't try and hide anything. The bank will find out. They're going to do their diligence. So be upfront. If there's a requires improvement, explain to the bank why it is. Share your action plan, what steps you've taken to do that. I suppose taking it further, an inadequate is more challenging. I think it's fair to say an inadequate home has its significant challenges. It's potentially most likely got an embargo that has impacts on occupancy and performance and profitability. It's very difficult for a bank to fund inadequate, especially on a standalone basis. You may look at doing one as part of a regional portfolio. So if somebody tends to buy the underperforming homes with a view to turning them around, you would potentially look at inadequate as well as requires improvement. But on a standalone, inadequate are very difficult to fund. I think we just need to be clear.
Yeah, that makes sense. I mean, if you're especially if you're under embargo, that's a challenging lender decision, because you're almost trying to put this in sort of slightly different terms, I suppose. It's almost like saying you haven't got a very good product at the moment, and until you can turn it around, even the CQC says you can't sell it. We shouldn't be selling your proper product to new people. That really does need to be changed. You need to be improved before you can. But if you were to, let's say, if I was I've got a portfolio of operating homes that are operating good or outstanding, and then it's like I want to buy a home that is requiring improvement, to turn it around, and I myself have got experience. Is that sort of somewhat of a different conversation?
We do them quite regularly. I have a number of clients who specialize in acquiring homes, and improving them and turning around. I mean, one I've just funded was for a closed home.
Oh, right, okay.
So there was no income, and there's a cost to bring it up to standard. But because of the existing homes in the portfolio, we could support them.
You sort of
and we could potentially even do that for an adequate. Yeah, we could probably even do that in that situation for an adequate. I think the key is not relying on any income from that home to service the debt, which is why it works better in a regional or a larger portfolio than a smaller or standalone.
That makes sense. Yeah, I suppose if you're back to that experience management, kind of, okay, you want to open this home, who's opening it?
Yes, absolutely.
It's one of our best managers. Okay, that's much more understandable and agreeable than, we've just got this guy who used to do hotels and I'm sure he'll be fine.
Yeah, I think the latter case would struggle, but absolutely it tends to be the case. Is they tend, if that's their nature of their business to buy homes to turn around, they tend to have somebody who's not a manager in the home, but that's their job to go in and get it started and set up, and then a manager will come in.
Yeah, that kind of interim
to run it.
Launch
yeah,
manager.
absolutely.
Yeah, I've seen it before.
Yeah, I think it's worth just saying on CQC and regulatory. We could talk for a while on this. I'll try not to. It's accepted that CQC are not going in regularly to homes. They are focusing on one where there is an element of risk, or that something's been flagged with them. So some homes are stuck with a required improvement rating for a number of years. I think the earliest one I've seen is 2018, which clearly isn't ideal because it then asks the questions. But and again, I think this comes back to having a dedicated healthcare team that understands the sector. We appreciate that not all homes on required improvement will get an inspection within 12 months. I think that's the hope from the CQC, but realistically, we're not there at the moment. So again, it's understanding the circumstances behind that rating. If it's dated, to be fair, if CQC haven't gone back in, it's a dated inspection report, that gives me some comfort that they haven't felt the need to go in, even though the rating still says requires improvement. There are other things you can look at as well. There's carehome.co.uk for personal ratings. There's local authority reports. You can also ask an external firm to go in and do a mock CQC inspection. These are all things we can do to get comfortable if we're looking at funding and have any further questions.
That makes perfect sense. And I suppose that matters because this is really, I suppose, the first two. It's why does it matter? I mean, what would you say? It's kind of confidence, isn't it? Really, I mean, that's really what you're kind of driving to, but from multiple different data points. It's not just a rating. It's not just a person. It's a web of, and a patchwork of information that you're kind of
and I
getting
think
to the bottom of.
And I think we'll pick up on this a little bit in some of the other slides. There's a lot of nuance to the sector. I probably keep saying that word, but it's true. A lot of different areas interact, and from a banking perspective, ultimately we want to know how we're going to get repaid, and it's building a picture of can this home, can this group, can they generate ongoing sufficient cash and profits to repay a bank debt. And if you haven't got the right management in place and the home's not operated properly, you're going to have difficulties sort of moving past that onto the next stage of any sort of bank.
And I suppose that leads us quite nicely onto your robust business plan, the detail and evidence. I mean, that's kind of, okay, this is where we're at now, but this is where we want to be in the future. And I guess you're going to be kind of parsing that against, okay, you say you want to be here, but looking at where you're at the moment, are we confident that this is going to be achievable?
Yes, and I think that's the key with business plans. I mean, be realistic with them. I have seen some business plans that clearly are very stretching. Now, there's nothing wrong with having your own stretch plan, where your aspirational plan, where you want to go to. I probably wouldn't be sharing that with the bank because that's what we base all our decisions on, and we'll be setting covenants and comparing to you. But don't be too pessimistic. Just they need to be based in fact. Let the bank know what the numbers have been based on. What are the assumptions you've made? Don't just present a profit and loss to the bank and say, "Here's your projections."
So that's what not to do.
What not to do. I mean,
here's a bit of P&L. There you go. That'll do.
You'd be surprised. I've had that, and on a few occasions, it's like, "There's your projections." Well, I always say they're not the bank's projections; they're your projections that you need to support and buy into before you present them to the bank. Ultimately, they're your projections. They're not the bank's, but the banks will use them to make their assessments alongside any supporting existing financial information to make the decision.
And so, obviously, in some of your things, you've got sort of occupancy, staffing costs, compliance, maintenance costs. What if I don't know yet? I mean, I'm kind of not got that information in, because I've not run it yet. I mean, what would you be looking at? Would you say, well, I need you to come up with something and find something, or you should know it? What would you say?
Absolutely. I mean, ultimately, projections are only as good as the inputs, and the inputs need to be grounded in information. So, if it's a new business, let's say a new development on this occasion, there's no trading history. Use such as this obviously this Carterwood reports. Your valuation is a key element of any assessment. They'll assess the market, they'll assess the competition, they'll tell you what average weekly fees are, they'll make an assessment as to what they think is achievable at that home, even for an existing home with an extension or operating, they can do exactly the same. So the valuation is perhaps sometimes underestimated. There's a lot of key information in there for an operator and for the bank to give you exactly what you've talked about, that information that sort of validates the information that you've put into your numbers. I mean, you're right, occupancy fill up, average weekly fee, staff costs, they're the key drivers for any sort of healthcare. I mean, you're saying healthcare, care home business.
Yeah. A care home business. That makes perfect sense. Excellent. Okay, so talk a little bit about business fundamentals then. I mean, these are broadly speaking, not terribly different from any business, really. You kind of want to have a stable picture, a sort of good idea of what's kind of going on, but there is differences here in care. So tell us a little bit about that, and I suppose also, why does it matter?
I mean, at the end of the day, the banks are looking for certainty as much as they possibly can. I mean, just quickly going back to the projections, just to finish off on that, I know we've moved on, but people sometimes put projections up and say, well, what if I don't hit them? I mean, nobody's expecting the projections to be met perfectly. They are an expectation, and they're grounded in, a lot of the time, historical trading performance or the sector information. So that's a key core element to understand what is this business doing, and what can it do when we look at funding. You generally don't look at projections to base your serviceability calculations. Can you afford it? Because it's projections, it's forecasts. So we will look at actuals and what can this do when we're considering funding. So it's a key sort of starting component. I say the only difference that is if it's new development, you don't have any sort of past trading track record. You do have to look at forecasts, but that's why development funding is higher risk. And then you've got the fill up risk with developments once they're open, and you are taking a little bit of a judgment as to what that home can do to fund them.
And I suppose how quickly as well. So I mean, we build 2 brand new 66-bed care homes a month, and no matter how hard we tried, we never managed to get them to come with residents pre-filled. It just doesn't work. So we've got to go get them from somewhere. So we've got a whole marketing behaviors to kind of make sure we're going to get that. But also we analyze the demographics of the area to make sure that whatever the offering that we're going to be putting forwards, which they do vary, they're not always exactly the same from our own group, will fit well with that area. Population sizes, demographics, kind of like who else is operating in the area. There's a whole sort of a patchwork of things, kind of saying, if we build a care home here, and where are we pitching ourselves? Let's know our product offering, if you like. What are we going to be all inclusive? We're not. What are we aiming for? And yes, if we do that, we believe that we can get occupancy up to a certain point by a certain point, and therefore this home will start servicing its own debt, as opposed to, because it's obviously when it's in massive debt when it first starts, because you just built the whole thing and bought the land and and it's empty. So it's kind of, I suppose it's you're kind of looking at all of that together, really. And also how, on the sustainability point, because obviously you're loaning money for a period of time. How far forwards are you able to kind of, look?
In terms of funding?
Yeah, kind of like sort of, your overall kind of, projections
profile.
and, profile. Yeah. How far ahead are you looking, or wanting to be given the information for?
That depends on the asset, and sort of lifespan, or the perceived lifespan of the assets. I mean, the brand new shiny homes that you slush at yourself, 30 years in the future is not unreasonable in terms of that's how long you can take to pay a loan back, and you'll do interest only periods on a new build. If you're looking at existing home and acquiring existing home, if it's probably within the last 10, maybe 15 years, you could look at 20 years in terms of a loan profile. Now, banks tend to do a shorter commitment period, sort of 5 years, and then renegotiate after 5 years. But the actual repayments will be based on a longer profile. So 20 years, possibly 25, 30 for the brand new assets. if you're looking at an older home, or first home, a converted home, or say late 90s, early 2000s, you tend to restrict the amortization profile to 15 years. And that's just reflective of the age of the building, how old it will be, as you get into the loan repayments. In general, homes are traded and sold before. I think it's very unusual for a home to be retained, not saying they're not, but for the 15-year period or 20-year period, they tend to be sold on as people buy new homes and can afford a newer home, or the repair bill on that home is becoming too high, and so they're looking to sell, and they're the ones that exit the market and buy a newer home. That said, we're still funding the 90s, 2000s homes, which are 25 years old, as we talked about, as long as they're well maintained, and it's the care that's the key part. And I think what's interesting, not every resident wants a brand new shiny home.
Well, that's a really good point. I was just thinking about that when you were talking there. It's kind of shiny versus kind of, I suppose, more traditional style buildings. I mean, traditionally care homes have been in all sorts of different types of buildings, but kind of stately homes versus
Yes.
a new build that was built literally 2 months ago.
Yeah,
There's such a variation on it. Not everybody
absolutely.
wants one versus the other. I'm kind of thinking about my own parents. I think my mum would prefer the stately home, and my dad would prefer the shiniest of shiny. Yeah.
I think you're right. Something like the homely feel that you might get from an older home than the brand new ones, but the brand new ones have lots of features and facilities, and it's not one size fits all for everybody. I mean, just going on to age, last year I funded a home that was built in 1960s on a 20-year profile. So there's always differences. There's not one size fits all. That 1960s home had been well maintained, and you would not believe it was over 50 years old to look at.
Yeah, I suppose
So
it's about the care that's being delivered and the. I mean, was it refurbished at some point, or I imagine it
I
must
mean,
have been.
refurbish, yeah. I mean, internally, I mean, lots of fixtures and fittings and furnishings are obviously being updated, but the fundamental building was still as it was when it was built, providing very good level of care and full.
All right.
So I think that just comes back to our very initial conversation about understanding the sector.
So I've got two questions here. So I think we kind of answered the first one. That's why I asked the question I did. But when you have occupancy that varies significantly, plus or minus 20% over time, what is the best formula for projections? Is it average over a period, and what would that period look like? And I think you answered the period. I mean, it's obviously subjective. I mean, we're not giving you financial advice and banking advice here. It's more of a kind of you're talking about loan periods and building lives and things like that. But how do you kind of look at occupancies in that regard?
I suppose the first question would be, why has occupancy dropped?
Yeah, or why does it keep going up and down like that? Well, then
well,
I don't know how big they are. I mean,
exactly.
it could be.
I mean, 20% reduction or increase. I mean, I wouldn't expect a 20% increase significantly would happen under a quickly. I think that would be.
The person's just said respite. That's why it's going up and down.
Right. Yes.
Thank you. That makes a lot of sense.
Again, I suppose the challenge with respite care, if occupancy is going up and down, it's all to do with the income that you receive from that home, and ultimately the profitability, and any period of spikes upwards and downwards in occupancy will make it more difficult for a bank to assess the fundamental profitability over a period of time in that business. It's whether you probably can't predict when the spikes are going to increase and reduce. I mean, interestingly, we've just been having conversations about, can we structure loans a bit like in agriculture? Let's go slightly off track. You know that in the September they get the income in, so you structure your loans to be repaid in September. And if I've not come across this, but just thinking of out loud, if we know when the peaks and troughs are, you could potentially structure a loan to meet those cash flows. But I suspect it's more
makes sense.
uncertain than that.
I suppose it's a case by case, as you said earlier. You do have to
Yeah,
look at these things in detail, but at least you understand it. As from being experts in care, because I suppose if you sort of if you said, are you a viable business? Your occupancy goes up and down by 20%. Okay, but what is it when it's, let's do that over a year. Let's do that over 2 years. What does that actually look like? And it's like the average of the average is actually you're normally sitting at,
yeah.
you know,
I think
at
on that, I'd look.
90%, which is pretty darn decent, or
Yeah,
whatever number it might be.
I think on that, I wouldn't necessarily average it out because if
No,
you've got
okay.
respite, it's going to be up and down. So to
Hmm.
average it out probably isn't then going to accurately reflect what the cash flow is going to look like.
Got you.
I'd be more tempted to look back at the trends and use the
Hmm.
trends. Is there any period where you're seeing an increased
Yeah.
spike or a reduction? Um, Winter, unfortunately, does see a reduction generally, in occupancy
Hmm.
in care homes, which then
Yeah.
picks up again in spring, unfortunately, because of deaths in the home over the winter period, which regretfully is something that every operator has to
But
have
I
to
suppose
manage.
I suppose really what you're saying is that there's possibly or there's probably an answer for any question really, as in respite. You're not saying, oh no, respite we could never loan to
No,
a business that has a lot of respite. It's more of a we'd have to look at that more carefully. But actually, maybe averaging isn't the right answer, and maybe some
no,
seasonal behavior might be
I,
more
I don't. I
appropriate.
don't think averaging is if you know
Interesting.
that
Yeah.
you're going to have um, fluctuations in occupancy. I mean, it's unusual. I mean, I don't know obviously the who's asking the question, the person asking the question, but it's unusual from my experience to see a home purely on respite for that very reason that the fluctuations in profitability and cash. Respite is part of the home, maybe one of the
Yeah.
floors, and the other two floors will do residential or nursing home. So it's a mix of care rather than true respite, but obviously that may be the
Well,
case for
I've actually got this
some homes.
specific customer, which is helpful for a bit of context. We're a very small home, handful of unoccupied rooms affect percentage significantly. So
Hmm.
that's why it's such a big, a couple of rooms,
Yes.
big switch. Winter
Yeah.
period actually for us is high in occupancy period. Respite for us generally leads on to permanent either then or within 2 years. So yeah, I suppose it's to answer the question is there's, it's the devil's in the detail, which,
Yeah.
we're obviously just doing a webinar for a lot of people, but there are different tools at your disposal in order to kind of answer that question number five. It's not necessarily a deal breaker because I think if you were kind of an 80-bed care home and it was 20% up and down,
Yes.
that would be
Absolutely.
very
Yeah.
concerning. Whereas if it's a smaller home and it's that's there, then things can still be done.
And we see that in specialist care as well. They tend to be
Mm.
smaller
Yeah, of course.
settings.
Yeah.
And you're right, and higher fees in specialist care. And that is something we have to bear in mind as a funder. And it does reduce potentially the amount we can lend to a more sustainable
Yeah.
level. I haven't talked about leverage as such, with leverage being debt to EBITDA and is before interest, tax, and depreciation, which is the fundamental measure the banks use. Um, for a specialist asset, older asset, you might be just restricted 4 times debt, debt to EBITDA profits, and just to take into account those fluctuations and the higher risk of like I say, one or two people in those circumstances can see a significant fluctuation in profits. But you will look at them, and again, it comes back to that point, understanding that
Mm.
business and that sector to be able to look at it correctly and
Mm.
understand what's being presented to
I
you.
suppose holistically as well, it's kind of really getting understanding a lot of different factors that are
Yeah,
not just a
just
number on a
on
page.
just on that specific point. I mean, if a lot of your respites are then going on to permanent residence, that you can model that because
Mm.
you've got evidence. So if 50% of your respite become residents, well, model on
Mm.
that basis, so you can smooth out the occupancy peaks because you're not seeing them. But I accept a smaller home, 2 or 3 residents, is a bigger impact
Yeah.
than 80 bed.
Cool. Well, I've got just another quick question first. About you saying some of our homes are from the 90s and one's from the 60s and still
Yeah,
absolutely fine to lend to. Somebody's just Maddie's popped up here and said, "What about the 1800s?" Yeah, that's a good one.
um,
Uh,
absolutely. I mean, you mentioned stately homes.
yeah,
You
yeah,
know,
they're even earlier sometimes, aren't they?
Absolutely, and we have funded stately homes. Now they're a bit quirky in layout sometimes. They're more difficult to manage because of the configurations. Might need higher staffing, so you might find your profits or your staff costs are higher, so it might impact on profits. But yeah, absolutely. And you know what? A lot of people want to live in a stately home.
Who
It's
who
an
doesn't want to live in a
opportunity.
stately
They
home? Go
don't
on.
get.
Is there who doesn't want to live in a stately home? Seriously. Russell, you seem to have muted just there. You've gone muted. That's weird. Try again.
Can you hear me, Ian?
Yes, although I think it's coming through your computer speakers now rather than your headset. Try again. No, no. Oh, say something again.
Hopefully back.
Yes, 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 yeah. That's it.
Well, apologies. Technology sometimes does this to my headphone for some unknown reason. Decides to switch itself off, so I do apologise for
So
that.
we missed just a couple of lines what you were saying there.
I think my last point was 1800s is absolutely fine.
Got you. Excellent. And then financial structure and deposits, kind of like your mortgages. You're saying that you were saying in the slide here that they're considered higher risk commercial loans. What
Yeah.
what is it that you're really trying to sort of say there, and why is it important to know about it?
I mean, higher risk comes back to everything we've been saying. It's not a standard residential mortgage. Straightforward income. This is your income. This is what you're repaying. There's a number of factors that we've touched on already that has to be taken into consideration when you're considering funding. So from that very perspective, it's higher risk because you have to take into account staff costs, average weekly fees, occupancy, changing regulations. So it isn't as straightforward as saying this is what I earn, this is what I pay out, and it's against the trading performance of the business in general. I mean, some funders, I'm talking in general about Virgin Money and how we assess funding, which is cash flow driven. Some funders will look at loan to value. So that's not something we tend to look at. It's more a case of what's the cash flow, what's the profits, can you afford to repay the debt? So that's really why it's higher risks. And in terms of deposits, it's normally 30%, maybe a little bit higher if it's a higher risk. If you've got a portfolio of homes, we can use equity in the other homes. I have done 100% funding for regional operators where the leverage, so the debt to profits is relatively low, and we can use the profits there. The key for us is debt servicing. Can you afford to pay it? Ultimately, cash repays debt, and that's what we want to assess. I mean, it is possible that personal guarantees may be required, especially if you're relatively new to the sector. I have had instances where the question is, well, why should I give a guarantee? I mean, ultimately, it's only ever going to be called on if the business doesn't succeed. And by giving a guarantee, for me, that's showing your support and confidence that the business will succeed. It's not always needed, but I suspect if somebody new to the market or relatively new to the market, that may be something that's asked for, but not always.
Got you. Right. So again, case by case, very much what you're saying here. But still these are options and possibilities. So makes a lot of sense. We go back to management controls again. Some additional management controls. Actually, somebody's just popped up there. What covenants do you usually require for this type of loan? So that's can be a simple answer, or it can be a long one, couldn't it?
I could make it as simple or as long as I wanted to on covenants, I think. I mean, fundamentally, you'll have a loan to value covenant in there. Banks tend to revalue every 3 years just to make sure that, and the valuation for care homes in our perspective is based on the trading performance. So it will be a multiple of EBITDA. And new homes might get a 12 times multiple. Older homes might be at 6. That just reflects the age of the buildings and the quality of the buildings. So loan to value, 65, 70% as a rule, reflective of the deposit or the equity on a regional portfolio that we look for. The other two key ones are leverage, we've spoken about before, debt to EBITDA, profits, and that just is set at a level where it should be comfortable for the business to repay the debt. So if you set it at 5 times, you then assess what's the profitability required to meet a 5 times leverage covenant, and your debt servicing is comfortable. So it can still come to be repaid at that level. Your other one then is debt servicing. It could be an EBITDA covenant, and if anybody needs me to explain the acronyms, there are hundreds of acronyms in the healthcare sector. I do apologise. If there is a question on any I use, please just shout out, put a question in. You've got CFADs, which is cash flow, EBITDA, debt servicing, less your tax, less your capex. And generally, you want that to be between, you set the covenant maybe at like 125, but you might be looking when you're doing your analysis to be higher above that at 1.4 to give a bit of headroom if things don't quite go to plan. And it's all set, again, to make sure that the business can afford the loans. And there's triggers in there just to highlight there might be an issue so we can work around that before it becomes a significant problem. You might have an occupancy covenant in there. We've tended to move away from them because it's quite a blunt instrument, occupancy. You could have a 75% occupied home, but specialists making more money than a 90%, but charging a lower fee. So you might have that, but it's quite a blunt measure. So the key ones are LTV, leverage, and debt servicing. Hopefully that answers the question.
Got you. Actually, Maddie's popped up again and said LTV of what? MV 1, 2, 3.
For us, it's MV1, which is the FM, what we call a fair maintainable trade valuation. Other banks will do it as VP. MV3, I think, is a proxy for VP, which is basically a closed home. Bricks and mortar, maybe, is another way of perhaps putting it. But for us, and again, this is why you need to understand the market and the sector and the numbers behind it and make sure they're robust. It's on the trading valuation.
Yeah, it's very much a business loan as opposed to a kind of a loan on a property.
A property loan, yeah.
From your perspective, that makes perfect sense. And I suppose, I mean, you were talking about covenants there, but they're not necessarily covenants in sort of 0.7 here, but they are key kind of elements that you're looking at. So, cost controls as well. They're things that you expect to have to be in good order.
And I think this ties into the financials that we've got, from performance to date and the projections. Government regulations are changing. Costs have increased recently, and they're going to continue to increase. So a key one there is, staff costs. What does it look like going forward? Agency is a big cost for any home. I think as a general rule, we're seeing agency usage reduce. But again, if you're going to project reductions, just explain how and why. We have an idea as to where costs should be, in the sector. Staff costs maybe between 55 and 60%, maybe a bit higher if it's nursing, depending on the market. Other running costs maybe 12 to 13. Don't quote me on those figures, but that's roughly where I think they are. So any variance to that would probably pick up and ask just questions. So just understand your costs if the bank comes and asks for sort of a more in-depth explanation. And we will stress test costs as well. So we'll do a test on staff costs. What can they increase before covenant breaks or before break even's reached? And same for occupancy, based on average weekly fee. What reduction? So we have an idea, and this helps set the covenants as well. How much headroom there is for things to change before it becomes an issue.
Got you. So almost like you're kind of above your top and bottom kind of margins of what ifs. What if
Yes,
this went up?
absolutely. Yeah.
I suppose it's a little bit like a normal mortgage, isn't it? You know,
Well, in a way,
what if the interest rates were to increase to X? Could you still afford it? I mean, it's got the same
And
logic to it, really.
We will do interest rate sensitivity as well, obviously,
Yeah,
unless it's fixed.
Unless
if it's a fixed rate and it's interesting at the moment, debate as to whether you fix or not. I won't go too much into that, but there is that option to fix, and that again just you then don't have to sensitize interest because you've got certainty over what it is.
So taking almost that little margin, so that little equation out of the picture and concentrating on the others.
Yeah.
And then sort of property quality, future proofing.
I think we've touched on this a little, quite a lot previously. Actually, I mean, it's just going back to some banks have different views as to what they'll fund. The newer ones, the older ones, the converted properties. There's a market for them all. Brokers are very useful if you want to look at get into the market, perhaps for the converted properties. We have good relationship with a lot of the regional operators, so they'll come directly to us for funding. But I think we've probably could. The only thing I probably would pick up on there is, and it's becoming a more focus from credit perspective, is ESG.
So the
I think the S and the S and the G, I mean, it's ESG. The S and the G, I think the sector covers very well. The society and the governance piece. Environmental, especially on new builds, we are focusing more on the environmental aspect, what's been done at the home. And again, even for existing operators, EPCs, there is a requirement, I think, for them to be C at some point. So there's one thing on funding requests is just make sure you've got your fire risk assessment done and it's available and up to date. Asbestos report is available. ESG is up to date, and you're able to provide it to the bank. Sorry. The number of times I've had to go back and request that, and it can hold up funding decisions because they are required. So if you're putting everything in place to ask for funding, there are three things there I would just make sure you've got, and they're up to date.
And that would help smooth the assessment of the loan application if you've got that done before.
Absolutely. Well, the valuer will ask for it as part of their valuation. Or they'll make assumptions without it, and that could impact on the valuation. So absolutely, these are things that just make sure you've got.
Yeah, I suppose you don't want to make an assumption that's incorrect, as in, well, we assume because the building is of X, Y, Z age, and we will, we just assume this. You really want to kind of, if you've done some work in your fire safety, for example.
Yeah, really fire risk is fundamental for the running of the home anyway. But as a bank, we like certainty. Yeah,
you want sort of, and that would be evidenced from third-party reports and that kind of thing. Yeah, so it's rather than trust me, I'm all right.
Yeah, I mean, an interesting one that came up obviously was RAC, RAC, especially in older homes. Just recently, is that something else that does get a focus to be considered? And obviously, is it present, and if so, what's the mitigations?
Makes sense. Got a question. So how much does operational practices play into your decision to lend and the confidence you have in a provider's future performance? I imagine it's kind of high, really.
It's key, ultimately. Everything stems from the operational performance of the business. Whether people want to go and stay at that home, whether staff want to work there, what fee potentially you can charge, what rating you get from the CQC, what profits it make. I don't think without good operational performance, you can really go anywhere. It's the starting block for everything for me.
Yeah, that makes sense. It kind of if I give you this money, I know I often make these things like simple, but like, if I give you this money, are you a safe pair of hands?
Yes.
And what do I need in order to make myself satisfied? Lots of evidence, etc. But ultimately, yeah, it's got to be strong on that, because otherwise you sort of like, there are other things that you could do with Virgin's money. that would get
well, yes, absolutely.
get that money returned back to them with a little bit of interest, as opposed to loaning to somebody that's you're really not sure about. So
Correct.
an interesting one: market position and local demand analysis. So we obviously covered off point one, or so before the point one actually was market outlook. So the market is definitely sound. We know
Yep.
that it's a good place to be, and provide services, and there's a lot of potential for growth if you want to grow. But what about your kind of local demand?
Yeah, I mean, the valuation again will provide competition analysis, but I think it's just you need to know what your market is yourself. Keep an eye on the planning portal or the new homes. Is there an LNT home being built near you? More than likely, with the number that's been built.
Probably. chuck a rock and you'll hit an LNT window.
Absolutely. I mean, there are reports that you can get if you're looking to acquire or develop. What's the competition in the area? What is on the planning portal? What's the staffing like? I mean, that's something that sometimes it's not just about competition, but what staff availability, nursing and staff. There was one home I was looking at in the northeast. It was in a village. It was a lovely village, I think, but it had one bus route. So the first question there was, well, how are the staff going to get there? And it was like an 80, 90 bed home. So it's just looking at all these factors when you're considering maybe building or acquiring a home. Now, obviously, if you're acquiring, it's got a track record. If it's 90, 95% occupancy, you've got a good sort of track record of how well that home's performing. But if you're going to develop there, what is the competition? And it might not be that there's demand, there's an undersupply in the area. There might be an oversupply, but what care are you providing? Again, one I was looking at a couple of weeks ago, it was specialist care, nursing care. And there was a shortage of nursing beds, but an oversupply residential. So again, just understanding the sectors within the sector, not just looking at the headline figures.
Your local area. Did you said about that kind of like bus routes and things? I was talking to somebody at the Lincolnshire Care Association event, and there was just general questions on how are things, what kind of challenges are you facing? And they said, for restaffing, and I was like, in my mind I was sitting there going, well, I'm not surprised at that. And they said, yeah, we're in areas that the bus route has just been changed and it's stopped.
Yeah.
I was like, what do you do about that then? They said, we're making our own bus route. The care homes are getting together and to get buses to, and you're like,
excellent.
That is not something I would have thought of that a care operation would have to do, but it's kind of like it's a necessary evil. But I mean, would you build a home in that area if you knew that was the situation? That would be kind of crazy, wouldn't it? Really? I mean, that's quite. It would be
one of the questions. One of the questions we would ask is, can you staff the home? In our diligence, as much as can the residents. I've got demand for residents. I suppose the other thing on competition is what type of care do you provide? Is it local authority or private? They're two very different markets.
Yeah, absolutely.
Some areas you talked about, would you build a home? Some areas perhaps wouldn't support a new home because of the demographics, but local authority homes acquiring existing would do very well.
Yeah, that's a good point. Yeah, and I suppose as long as the debt can be serviced, which is the main thing, then that's absolutely nothing's out of the possibility. I've got another question. Just we've got to be kind of quick because we're running towards the end here. I'm sure it helps to validate management, but do you take into account industry awards? Good question. Love it.
Absolutely, and we sponsor many of them.
Well, there you go.
Just conscious of time, I thought nice shot on. Absolutely.
You do, yeah. I mean, they're not easy to win, are they? So it's definitely tells you something.
Even being nominated for the awards is seen as a positive, because you're right. Only one person can win, but getting there is still an achievement.
Certainly. So when I put this presentation together really quickly, I actually the first slide that we had was one that was the market outlook. I took it from a presentation that Matt Lowe, our CEO, made. And I thought, you know what, there's a couple of other, just two slides that are kind of relevant that I thought I'd just include. And it's very much in line with exactly what Jonathan's been saying here, which is you when you're running, and if you want to grow your care home group, you absolutely have to have quality outcomes. We believe in management ownership, so there's a real accountability within things. Because we build our own care homes and they come empty, then the inquiry management is incredibly important for us as a group. And then your management control, so that's like data, understanding your staff, etc. And these are all internal processes. These are not kind of like for lenders per se. It's more about, this is how we're doing things. But one of the key ones that he feels is important, because you're looking at up to 20 homes per care home group, and then multiple groups. We're very interested in data. And of course you do, but the actual data of a requirements of a large group are not really that different from a small group or even just one home. It's kind of looking after your KPIs and everything that's going on. So I've just sort of thought I'd add this slide, which is from that presentation, which is kind of like, so from CoolCare, this is a blatant plug for a minute, but it's all about inquiry management, workforce management, time and attendance, and resident invoicing. So that's the money in and the money out. The care planning is what's going to help you. The care planning software is going to help you with your data for your care management. They use person-centered software, but other brands are out there, and we're partnered with PCS and Nourish. And we have integrations with both. But an important thing that we always look for in the kind of wider group is weekly KPIs, on the clinical oversight, but also on inquiry performance, just keeping on top of that. Your staffing levels, forecasts of staffing levels, financial performance and controls are all kind of internal things. It's not for the bank, it's for themselves. And then looking for trends. So review the KPIs and looking for variances between the different homes. And Matt kind of like in the thing kind of makes this page turning kind of thing, but that's where you can then identify where you put your time. And I think information, we would say that because we're a software provider, but information doesn't necessarily have to be a massive laborious task to pull together when you have good tools that can kind of give you this information. And if you were to want to borrow money from, let's say, Virgin Money, much of what you've already been doing here in this space would be exceedingly useful for a lender. You're able to kind of prove where you're at. But there you go. So just to sort of finish off then, Jonathan, what ultimately sort of from a summary, what is it that makes a care home bank ready?
Everything on that screen.
Yeah.
I think we've covered it all off. I mean, for me, I think on top of what was done, just be open and honest with the bank. They will review the information that's provided, provide the information that they require, and work with them. Banks ultimately want to lend money. That's what they're there to do, as long as the business case supports it and the payments are affordable.
And all the ducks are lined up, and you can kind of make your assessments, smoothly and efficiently, and you've got everything you need, and the whole thing sort of adds up. That makes sense.
Yeah, definitely.
Some closing remarks just from CoolCare's perspective. So there is obviously a positive market outlook. Our own customers support that. So we've got approximately between 16 and 17% of the UK's care homes are on CoolCare. The data we pull from our own sort of macro data, our customers' average fees are 1,619. So that's seen quite a significant increase over the past 3 years. 85% plus average occupancy. I said plus because it depends on there's various different factors in your occupancy. So if you're an empty home and you're growing, your occupancy is different to private funders and self funders, etc. 57% of our customers, residents, are self funders with a 44% average win rate. That's a lot down to our sort of CRM system. And of course, we know that management controls, strong systems are really a prerequisite for lender confidence and also management confidence as well. So it's all about sort of digital transformation. There is a lot that you can do with systems to help with that. And it's a really important sort of thing. And that's kind of it from our thing. If there's any questions, I've got a question, but it's more of a CoolCare. When are you going to add an extra level user to CoolCare so that you can restrict what employees those users can see and manage? I think we already have that. So I'd say just give our support team a shout on that one, because we do have lots of user level access management, of which there's quite literally hundreds of thousands of combinations of. So we should be able to get what you need. But if we can't, then we can certainly look at a support ticket to kind of help you with that. But broadly speaking, you can restrict staff down to being able to, or people users that down to being able to see absolutely nothing if you want, or one thing or 100 things. But is there any questions on what Jonathan's been talking about today? Any more to add before we sort of sign off here at the end of this this webinar? Nope, doesn't look like it. Well, thank you very much, Jonathan, for joining us. It was insightful, very interesting. And we'll be saving this webinar. We will send it out to everybody who's registered and attended the webinar, and we'll be adding it to CoolCare's YouTube page, of which if you just go to YouTube and Google CoolCare, you'll find us. We are not the people in America that do air conditioning units. Just to be clear, we're not the same people. But other than that, you should be able to find us just fine. Or if you go to our own website, we will have the web. If you click on webinars within the website, this will be recorded in there as well. And then if anybody wants to get in contact with Jonathan, you could probably stalk him on LinkedIn if you like, or alternatively, you can give us a shout and we can pass messages through, or maybe catch him at the next Care Show or other events around the country, or any of your sort of sit-down events that you're doing as well. Anything else to add, Jonathan?
No, just thank you for inviting me, and hope that was useful.
Excellent. Well, thank you very much for everybody who joined us. I now have to try and work out how to end this webinar. So that'll be fun. So thanks very much for attending, and yeah, hopefully catch you at the next webinar.